We're witnessing a turbulent period in terms of economic growth globally. There have been job losses in several key sectors, and countries, especially in Western Europe and the United States, have been contemplating various policy maneuvers to weather the storm, as it were. And some of these policy moves, especially with regard to interest rates and lending, uh, are being discussed widely across various international forums to manage the slowdown. Many economists have claimed that this could just be a passing storm, but it is crucial that we get a better understanding of what's going on with the global economy. I'm joined today by Arjun G Nagarajan, who is Chief Economist and Communications Manager at Sundaram Mutual. It is an honor to have him on Swell today because, given his remarkable experience as an economist, which spans over a decade, he is truly best placed to give us a good understanding of what's going on with the world economy. Arjun, thank you so much for joining me on Swell today. I want to start this off by asking you, in the recent past, markets have been volatile and behemoths such as Credit Suisse and other financial companies have taken strict measures with regard to job cuts due to the ongoing global recession. Can you give us your take on what's happening, and could this situation potentially be as grave as the 2008 crisis if the ongoing slowdown persists globally?
Good morning, Karan. Pleasure to be on Swell, and thanks a lot for having me. To your question, it's quite a packed question and a very pertinent one. So I'll just break that down into four broad pointers. On job losses, I think it is very important one has to read these job losses that one keeps reading in business papers in perspective. So what I mean by that is we read absolute numbers. One will have to actually put that in context. So COVID was a time where there was a significant amount of pickup in activity because both fiscal and monetary policy across the world was on overdrive. So because there was a significant amount of fiscal and monetary policy stimulus, growth picked up. And for example, in the US, unemployment is currently at a 50-year low. So all of these job additions that happened over the last couple of years will have to start unwinding at a particular pace when growth sort of normalizes as stimuluses are withdrawn. So, for example, all the job losses in the tech field that one was hearing in the months of Jan and Feb of this year, if one places it in context, only around less than one third of the jobs that were added in the tech sector during the COVID period have actually been unwound. So I think that is probably a context that for the first part. On the policy momentum, I think central banks are sort of stuck between a rock and a hard place, mainly on account of the fact that on the one hand, they are trying to address these financial stability issues that have cropped up over the last few weeks around banks. And on the other, inflation still remains fairly elevated and they have to really contain inflation. So they're trying their level best to keep rates elevated to contain inflation on the one hand, and on the other, they're trying to introduce as many policy tweaks as possible to see to it that the banking system still remains fairly robust. Now, the other aspect we need to really understand around the banking system per se is that the United States, largely we look at the United States as a representation of the Western world, largely because they still are, in a sense, an engine of global growth. So if you're looking at the banking collapse narratives over the last few weeks, you had largely three US banks, and then you had the takeover of a Europe or of a Swiss bank. So one has to look at these three US banks individually. So you look at Silvergate and you look at the Signature Bank. These two were directly related to crypto, but the Silicon Valley Bank was not really linked to crypto per se. It was largely a collapse that was because of very bad risk management practices, where they had a significant amount of interest rate risk exposure that they did not really hedge against. And as a result, when there was a sort of a deposit withdrawal, it turned out into a run of the bank in a sense. So one will have to look at all these separately. And one also has to keep in mind that if you look at the United States banking system, they have roughly around $30 trillion of asset size. Signature Bank would probably be around 0.7, 0.8% of the banking system. And the top 10, top 10 US banks account for roughly around 50 to 60% of the entire system. So banks like Signature, Silicon Valley Bank, their asset size is less than 250 billion. So regulations on these banks are also not as stringent. They don't really have to adhere to strict liquidity ratios. They don't have this stable funding ratio where they have to see to it that their deposits are not concentrated in a particular sector. So these regulations don't really apply to banks like SVB. That was also one of the reasons as to why this played out the way it did. Now, short answer to your question, is this a layman? Probably the answer is no, because growth is at a much better phase. Bank assets are also doing fairly well, and there aren't any concerns about recession as much as.
I think the point you were trying to make got a bit cut out towards the end, Arjun, because of the 5 minute time limit that we have on each post here on Swell. But thank you for confirming that this isn't another Lehman. I think that'll really make a lot of people feel relieved, given how many people have lost their jobs and are looking to kind of get back into their respective sectors. Just to sort of shift the context to what's happening in India. The Indian economy has seen corrections in terms of stock prices of several key companies, especially in the first quarter of this fiscal. Given the global situation, what is your overall read on the economy and how it's doing in this particular context, Arjun? And this is, taking into account all the parameters that we traditionally look at, which is FDI, employment, oil prices, and all of that. And I know this is again a slightly complicated question, but I really look forward to hearing your thoughts on this, because a lot of people again are keenly wondering how India is really faring given the global context.
Hey, thanks a lot, Karan. Just a bit new to this. So, like I was saying on the recession bit, one has to really remember that from a US point of view, there has been a lot of noise around recession all through 2022. My stance has been that the US is not going into a recession. There aren't any macro indicators even till date that are telling us that US is going into a recession. But then the question is, okay, where does the fear of a recession come from? The fear of a recession from a market point of view, if I ignore the yield curves in a certain sense, largely is coming from the fear of the pace of rate hikes that the US has been experiencing, that the Federal Reserve has been delivering. So over the last 12 months, the US has really seen 500 basis points, which is 5% of rate rises. The last time it was this fast, it was probably in the 1970s. And in the 1970s, the economy responded to such rate hikes with a recession. Now, there's definitely going to be a drop in growth, an appreciable one, but we still don't really think that it's going to turn out into a recession of sorts. I think that is the most important point that we need to keep in mind. And the Federal Reserve is very cognizant of this. They want growth to come down because it is demand-led inflation largely now. And in the process of growth coming down, they are trying their level best to see to it that it does not lead into a recession. So the financial stability concerns that we've been experiencing over the last few weeks, they're trying to address it by pumping in more liquidity to see to it that there isn't any fear, there aren't any rate rises internally, rather in the system per se on the shorter end. So yeah, so that's that on the recession part that I couldn't record. On India, it's been quite surprising that India has been holding up fairly well. So both from a markets point of view and from a macro point of view. From a markets point of view, one will keep hearing about how Indian markets are fairly trading at a premium. one has to again put this in context and notice that over the last few decades, Indian markets have always traded at a premium to emerging markets. So the question is, how much of a premium are we getting? So, and India's macro has actually been fairly strong. We're still going to be the fastest growing economy in the world. That is saying something. So whether it is a 5.5% or a 6.5% or a 7%, whatever the number may be, again, this has to be in context of the fact that global growth is only what it is. It is coming off these stimuluses, so global growth will be muted. In this muted backdrop, India growing at 7% for the current fiscal and probably 6.5% for the upcoming fiscal, I think is a very appreciable number. Now, on India again, all the macro indicators are holding up, but we have been, the RBI has actually raised rates by around 250 basis points from, I think, May of last year. The cumulative impact of these rate hikes will weigh down growth in India. It is a given. It's just a matter of time. But we don't, given that the economy is holding up fairly well, and it is holding up despite the absence of any significant fiscal or monetary stimulus from the government and the central bank during COVID. I think we are at a more sustainable pace of growth is what I would want to think. From the FDI point of view, from a point of view of oil, I think oil has been a very big positive for India over the last few months. So pre-COVID, India, our average oil crude was around $65 a barrel. That went to as high as around $122 plus a barrel. It moved down, and over from September, October of last year, crude prices have actually been coming off a fair bit, and that has been a big positive for our trade deficit that is now going closer to what it was pre-COVID. We are still at a much higher level. They're going closer to what it was pre-COVID. So from a currency point of view, I think there's some reprieve that India is experiencing, rather will experience into the coming few quarters. So that is a positive for India. Yeah, and just finishing up on that answer, the drop in crude prices in particular from around November last year, which was just under $100 a barrel, to currently just above $70 a barrel. I think this drop has actually been fairly a positive for India. So there are three counts. One, it brings down inflation, wholesale inflation in particular. Retail is unlikely to come down because retail is held up due to excise duty from the central government. Second, it takes off a lot of pressure on the rupee. So the pace of depreciation of the rupee can actually come down in the coming months, also because the dollar is not as strong. Secondly, it also brings down the pressure of financing because the trade deficit, like I mentioned earlier, is at a much lower run rate. The other bit is it gives a lot of wiggle room or rather breathing room for the RBI, because so far all the rate hikes that the RBI has been delivering, though its narrative has very clearly been that it's been to address inflation in India. If you look at the actual numbers and the actual macro metrics, it's very clear that the rate rises that the RBI has been delivering has been mainly to see to it that the rupee does not depreciate. So nearly 50% of the Federal Reserve's rate hikes has been delivered by the RBI. So the Federal Reserve has done 500 basis points of rate hikes and the RBI has done roughly around 250 basis points. So it is this attempt from the RBI to see to it that the currency doesn't really depreciate that one sees in the rate hikes from the RBI. So with crude prices coming down, the trade deficit coming down, slightly lesser pressure on inflation and slightly lesser pressure on the rupee, there isn't as much pressure now for the RBI to continue its rate hikes, and probably I think if I were to hazard a guess, I think at 6.5% repo rate, the RBI should possibly pause here and would probably stay at 6.5 for the whole of FY24, the fiscal year, till around March 2024 at least. That would probably be my guess, but this guess assumes that there isn't any new growth scare globally or domestically. So, given that backdrop, I think this development around crude gives the RBI a fair bit of breathing space on the rates front.
So Arjun, thank you so much for going into such great detail, and your analysis on what's going on with the economy is something that we were all looking forward to hearing. And I think, you put things in context now. And I know that I have a lot of research and digging to do. A lot of people listening in will have questions for you. And on that note, I'd like to open this conversation up. So if anyone has any questions, please do post them after my response. Arjun, once again, thank you so much. It's been wonderful having you on Swell. I've had a lot of fun getting to know you and connecting with you on this interview and then offline as well. I look forward to having you back very soon on Swell.
Arjun, this was a fantastic Swellcast. I loved listening to everything you had to say. I had a question that I've been, pondering for several months now. So this is with respect to the United States, because I live in the United States. I understand that the Federal Reserve has a target of about 2% for inflation, because end of the day, the GDP of the country is between 2 and 3%. So you want real GDP growth. You need inflation to be under 2, otherwise we are looking at negative real GDP growth. I understand the inflation target, and I understand why they're doing it this way. But I would flip the coin and say, rather than looking at bringing down inflation, why not look at increasing the GDP? And while I do understand that this is a huge economic powerhouse, there is a lot that the US is still capable of. There is a lot that it can do to increase its GDP. And that, of course, requires government spending. So while we tackle inflation and try to reduce government spending, I would say he shouldn't be instead be increasing government spending into projects, not into giving people cash, but into different projects to bring manufacturing back to the US, to make the US the next biggest center for electronics, for AI, for tech, and so on. For manufacturing, for industrialized goods, there is so much that that the US can do from from an economic growth perspective. And so I think there is a fallacy in pursuing the inflation number, and the reality is we need to be pursuing a higher GDP rather than a lower inflation number. What do you think about that? Because I also look at it historically. Look at what FDR did. FDR came at a time when it was actually, the US was in deflation. Now the policies that he put in place to revitalize the economy, because he also came during the Depression, and he also was a president during the Second World War, and so on. And so the policies, the whole set of policies that he rolled out, actually ended up taking the US away from deflation to an inflationary economy, because that's how much government spending was done to provide one of the most, I think, considered one of the best economic periods of the US. And so the focus at that time was not on inflation, but was rather on GDP. And I think it's a mistake central banks are making, governments are making, by focusing on inflation rather than focusing on GDP. This is just my thought. I would love to hear your thoughts on this.
Hi, Sudha. Thanks a lot for that question, and apologies for replying so late. So let me break your question down into three segments. One is inflation, second is government spending, and third is the Federal Reserve, central banks. Your question sounded fairly simple, but as I tried to answer it, I realized it wasn't simple at all. So I just break inflation down in a very simplistic way as a frictional outcome of demand and supply. So inflation is always the resultant that happens. So in developed economies and developing or emerging markets, inflation is very different. The drivers of inflation are very different. So let me put it this way. So demand, I think, is a self-explanatory word, but let me say supply. So supply from an economy point of view is broadly reflective of availability of the economy to resources, the amount of infrastructure or bottlenecks in the economy, etc. So in advanced economies, the availability to resources, access to resources, infrastructure, these aren't really problems. So there aren't as many supply related bottlenecks. So inflation in advanced economies is largely demand driven. Now, if you look at emerging economies or developing economies, you notice that you have a lot of supply related bottlenecks. So, for example, in India, most of the inflation drivers in India are largely supply related rather than demand related most of the time. So, demand is picking up, supply is not able to catch up to how fast demand is picking up, and as a result, you have friction and inflation comes through. So that, I think, is one differentiation to start with. So inflation is a result of what happens between demand and supply. Now, on your point on government spending. Now, yes, government spending, whenever there is government spending, it does lead, especially in advanced economies, it does lead to inflation, and fairly quick. Now, the nature of government spending is very important, and like you rightly pointed out, if there is government spending directly in the hands of people, demand picks up faster. But if there's government spending more on the supply side, so the pointers that you were talking about are hinting to more on the longer term supply side spending categories. So on those, I think there's much more sustainable growth that will cause, and as a result, whatever inflation does come through will not be very sharp, and it will be gradual over a period of time. And during that point in time, supply also has time to catch up to demand. So yes, that is a possibility, but inflation will still be a resultant effect of such government spending. It's just a question of how fast inflation picks up with the first category of government spending against the second. Now coming to central banks. Now, why does a central bank care to address inflation? I think it goes to the cliched answer. They don't want the economy to go into a state where they allow prices to go up, and you need boxes of money to buy a loaf of bread. The cliched answer. But the more important answer, I feel, I always have my sympathies to central banks, because the only tool that a central bank has to bring inflation in control is raising interest rates. One can argue that it's a regressive way of functioning, in the sense that you have to raise rates and bring down inflation, and how that works is you raise rates and you make it more expensive for businesses to do business, for activity, and as a result you're actually artificially bringing down demand, bringing down economic activity, and as a result you're bringing down inflation. There isn't any other way a central bank can bring down inflation. So this is the only tool they have. So when a central bank like the Fed is given a mandate to control inflation and keep it under check, this is the only thing they can do. Which is why there's always commentary, there are always economists, and there are always experts who keep talking about how it is extremely important for the central bank and the government to work hand in hand, that one does not cancel the effect of the other, in the sense that the government keeps spending, but then it keeps putting the responsibility of inflation to the said Fed.
Hey Arjun, thank you so much for your response. And while I understand that the points that you make in this, my question still remains: why should we look at the current inflation and tackle it as through monetary policy? Why is it that the only tool we seem to have available, at least from a United States perspective, in front of us, is monetary policy, where the central bank tries to bring down inflation because the GDP growth isn't happening on the other side? Rather, if we look at it from a legislative side and say, look, let inflation stay where it is, and let's look at legislature to improve economic output, and whether that is through government spending, which, as you say, might further increase inflation, or maybe it is by deregulation so that business becomes easier, right? That's not government spending, it's deregulation, it's policy changes to make it easier to do business, to make it cheaper to do business, and so on, and thus improve the GDP. All I'm saying is there are two numbers here. There is a GDP growth number and there is an inflation number, and everything doesn't have to be just monetary policy to manage inflation. There has to be a lot of thought given to also the other number, which I look at as a numerator denominator kind of play here, saying, hey, one way to bring down a number is either increase the denominator, which is increasing the interest rate, or increase the numerator, which is increasing GDP growth rate, right? And I sincerely believe that there is no thought given by legislature to its responsibility in this. They have a legislative responsibility to bring about policy to improve GDP growth rate. And it seems to me that people have taken the easy way out and said, hey, it's all in the hands of the central bank, our hands are tied, monetary policy is the only way to do it. No, that's not the case. I do believe that there is a strong need for legislature to wake up and say this is in their hands. It's like when a company is, looking at their future, they can either look at increasing revenue or cutting costs, or they can look at both. But increasing revenue should never be out of question, and that is in the hands of the legislature. And I feel that they're just not stepping up to their responsibility, and other countries are just looking at the United States and following suit. And I think that's wrong.
Hi, Sudha. Thanks again for that. Okay, let me try and address your question directly. So you're asking me, why should we look at inflation and why should we tackle it only through monetary policy? Can't legislative do anything about it? The answer is we don't have any other tool to tackle inflation but through monetary policy. Legislative changes can be done, which loosely you can translate that into supply side measures, making ease of doing business, all of that. But it will take a very long time for those changes to actually translate into something on the ground and for it to ease inflation. So the only tool and the fastest tool that one has is to raise rates, curb activity, and bring inflation down. So the route that you're talking about, I think it's a very legit question, but the only problem from a practical policy point of view is that it takes a very long time for that to bring inflation down. Now, let me bring the GDP and inflation narrative that you were talking about again. So inflation is always a result of the friction that you have from demand and supply. So it's a resultant equation, and the numerator and denominator point that you brought about on GDP being the numerator and inflation being the denominator, you have to sort of put it in the framework of the fact that if you spend on capex and supply side measures, the denominator grows at a slower speed. If you spend on income increasing measures directly, like what we've actually seen in the last couple of years, the denominator grows much faster. But in the context of all of this, we'll have to place the inflation that we are seeing today in the context of, let's say, the last 30 years, last 40 years. So pre-COVID, US inflation on average was hovering in and around 2%. There was not any significant concern around inflation in the US the focus was a lot only around growth, and you had Trump's, and you had Trump coming in, you had growth during those phases go up, the corporate tax was cut. So there was a lot of tweaks here and there, but there were also negatives in the sense there were tariffs that were imposed in Feb 2018, so on and so forth, that pulled down growth at the same time. But the considerations were slightly different there. But the point that I'm trying to make is, before COVID, on average, both US inflation headline and core inflation, which takes out energy and food, both of them were hovering in and around 2%. Core inflation in particular, the average is actually well below 2%. If you look at the average pre-COVID. Post-COVID, the situation is very different, because the post-COVID inflation is largely a resultant of the fact that supply bottlenecks are very significant. You heard of chip shortages, you had shortages of commodities, and you had a sharp increase in inflation on account of that. And by the time the US inflation or the US economy sort of started to normalize, you had the Ukraine-Russia war that added another layer, a thick layer of supply-led inflation, especially on the commodities front, that kept inflation much longer. So the only way to tackle this sort of supply inflation is only through rate hikes. Now, one other thing in this numerator denominator equation that you're talking about, we have to remember, is the reason why inflation in the US pre-COVID was so low is because US has outsourced a good part of its production. So because of our importing goods from China, importing goods from the rest of the world, it has actually been able to keep inflation fairly low in the United States. So from a legislative point of view, if for example, very hypothetically, we are in a globalized world, so this is not possible, but if one has to hypothesize, if you had to avoid the inflation that you saw over the last couple of years, you should actually start producing all of it in the US, which would then mean that by default prices would significantly go up, because cost of production in the US, wages in the US are fairly high. And I'll add one more point to the above. The fact that central banks have only rates to tackle inflation, despite the fact that this is not demand-led inflation to a large extent. Almost a very large chunk of the inflation for most part of the last couple of years has been supply-led inflation. It is only over the last couple of quarters, or slightly more than a couple of quarters, that you've actually seen a significant increase in core services-led inflation, which is largely demand-led inflation, because US is completely in that recovery phase post-COVID. So despite the fact that it is supply-led pressures that are causing inflation this time around, central banks have no choice, because if they do not really bring down inflation by raising rates and bringing down demand, though demand is actually not the main reason, if they don't do that, you will have prices remaining in the system elevated for a longer period of time, longer than the comfort for a central bank, and goes back to that cliched comment, if it continues, you have this hyperinflation narrative that could come through, stagflation that could come through. I'm just extending the argument. So ideally, this is not the best way to do it, but given the circumstances, this is probably the only way to address inflation. Thanks a lot for the question, Sudha. Help me to articulate myself as well. Thanks.